Welcome to Beyond Bitcoin, a podcast about all things digital assets, the global communities they are creating, the generations that are using and investing in them, and the challenges faced by the nations that are seeking to regulate them. The content of this program is not to be taken as investment advice. My name is Derek Graham. I'm the CEO of Portal Asset Management, and my co-host is Nitin Gower, Director of IBM Digital Assets and CTO of Portal. Good morning, good afternoon, good evening, wherever you are in the world, and welcome along to Beyond Bitcoin. It's morning here in Australia, and it's evening over there in Austin, Texas. Hello, Nitin, how are you?
Hey, Derek, I'm fine, and good morning to you. Hope you are going to have a great day ahead.
Good on you. Hey, Nitin, you're in Austin, Texas, and I've got to say, Austin, Texas seems to be becoming the New York hub of conferences now for the crypto space. But between that and Miami, there's just an enormous number of conferences coming up, aren't there?
Absolutely. We had South by Southwest, which was a big conference. It started as a music conference, and this year it was dominated with NFT and metaverse. Of course, in June, as you know, it's one of the world's biggest and flagship blockchain event, which is Consensus, that's happening in Austin, Texas. And in between South by Southwest and Consensus, we had many of these small events, both in Austin and Miami and New York. So there's obviously a lot of momentum, and it's impossible to keep up with so many events. I guess just there's too much going on, Derek.
And that's it. There seems to be an extraordinary hunger for information and an extraordinary desire to provide it. And so we're seeing, to see Consensus move from New York to Austin, Texas is extraordinary. And to see this hunger that thousands of people are attending these shows you the momentum in the space. But what I thought you wanted to talk about today, you said that you really wanted to talk about information providers, et cetera. And yeah. This is very relevant because there's so many information providers in this space. Messari, of course, we use regularly. We mentioned it on the show. Coin Trading View, we use. And then the regular ones that he uses, Coin Metrics and CoinGecko and CoinDesk, of course, for information. Yeah. There's dozens of service providers that are providing either technical data, blockchain data, conference attendance data, et cetera, in the space. But I guess maybe we could take the audience for a bit of a journey about where we think the information availability is in this space at the moment and how it's growing, and maybe a little bit about how we use this information best when we look at our funds.
No, absolutely. And Derek, and before we go into our meat of the topic, the reason why I think conferences moved from New York to Austin is because we have three essential things in Austin. We have great barbecue, we have great beer, and we have great music. And those are the three essential things which is attracting so many people from around the world coming to Austin.
Would have been said better.
Yeah. Moving to our topic, I really wanted to focus on market data with respect to crypto, which is essentially information when, codified becomes data, and data when modeled and, it becomes insight. And why is it, what is it and why is it important? Only because this topic has been very sort of seminal lately in terms of fund management, but also in terms of how VC evaluates a project. How should people look at it? It's not just about investments. It's not just about looking into projects, but looking into the fundamental analysis that we have done. And in painting that picture, before we get into data, I think I'd like to discuss some basic concepts first. And I think, Derek, we should have two sessions. One is the basics. So in this session, I think we should discuss some fundamental elements. In part two, we should get into a bit more advanced topics, which I think are essential for our audience to understand the vitality and importance of this particular topic. So a few concepts. Let's discuss the few tenets of this industry: price, value, and what has become eventually what Fama and Finch talked about, which is efficient market hypothesis. Price is what you pay. Value is what you get. And in between those two, there's a tug of war where what the efficient market hypothesis is, it's in financial economics, state that if an asset price reflects its all available information, there's a direct implication that that it is impossible to beat the market because everybody has the same information. And the calculus is to get the best price. Essentially what we do with traditional securities and other asset classes, everybody wants to get the best price. This is where asset pricing comes into play. So there are a bunch of models that are factoring all the data to give you what is the best and fair price of a particular asset. And to maximize the best value, we go into things like risk adjustments, forecasting, predictions. And we need all kinds of data in factoring in what could be the risk behind an asset, whether it's macro risks like we have seen with the wars and the lockdowns and pandemics. These are all risk vectors that are taken factor. So you have price and you have risk. With all the data available to us, the financial economic industry and the mathematicians and data scientists have gone to work and model after model, and it's taken us almost about 3 or 4 decades. So in traditional markets, which is dealing with 4 fundamental asset classes, you have market data providers which have evolved over time, who are providing a service to you, which has again evolved over 3 to 4 decades, who are not just providing market data. They have moved up the echelon in giving you analysis and insights, which again, the trading and the financial community has used to figure out as to what is the fair pricing. And in that entire arbitrage, a difference between price and value, this is where things become interesting from a perspective of investments. So market data in broad terms, again, describes the financial information that's necessary for carrying out research, analysis, things like trading, accounting of financial instruments of all asset classes in world markets. So that includes your FX, which is foreign exchange, the differences between the various economic value systems, looks into the pricing based on how a company is performing, what are the sales figures, revenue per employee. And so you have all this data over time that begin to reflect what is the real price of a particular asset class. So data is information that goes into price, value, risk calculus that we have seen. And essentially it consumes other macro factors such as inflation, money supply. And we have seen that lately, that inflation eats into your overall, and that's why there's a general sort of consensus and there's general pieces where money begins to move to other asset classes because of the value of money going down. So there's inflation, money supply, global events, and an impact of commodities essentially, which makes the market efficient, or aim to at least make it efficient, because suddenly now you have all the information in terms of, let's say, a supply of lithium goes down. Next thing you know, it impacts the electronic industry. Same conversation we're having with rare earth metals on electric vehicles and so on and so forth. And the regulatory moats that exist to prevent some participants from taking advantage due to this information asymmetry exist, only because we didn't want certain individuals who are close to the industry to have undue advantage. So things like insider trading, things like releasing information at a certain time, whether it's labor data, all that ties to information and data. And that's why it is so important, because oftentimes all this goes into a calculus, which when you're buying and selling securities, or even you're trading into asset classes, when you're buying a house, all these factors go into it. And it's important to understand this basic fundamental premise before we go into the next chapter of this discussion. But I'll pause here, Derek, to see if any of this made sense, or this is too out there.
Very much. No, look, I recall that great movie, Wall Street, where Gordon Gekko said, if you're not on the inside, you're on the outside. And in this space, I've got to say, every time I'm presented with a token or something, or an opportunity to invest, it's always, this is special information. As people discuss tokens, and the speculators and gamblers in the space, the retail investors, they're always wanting to invest in something they think they've got inside information on. And frankly, the space is rife with it. And having sat on listed company boards for many, many years, it's highly disciplined about what is inside information, what is outside information, knowing that there is a big stick if you actually step out of line. In this space, that sort of regulation hasn't existed at the moment. And there's a lot of information available, some of which might be considered inside. How do you think that's going to be coped with along the way?
No, that's exactly the challenge, right? I think if you look at the entire regulatory landscape, and SEC and other equivalent agencies around the world, the FATF, the BIS, the Basel committees, the IMF, all the global bodies are talking about this under, of course, the pretense of investor protection. and ensuring that you have enough sort of information available. And that's one reason why SEC has not yet approved a spot ETF, because, fearing the market manipulation, fearing the fact that it could impact a common person, even though the industry has been there for, Bitcoin has been for 13 years. There's enough data available, as we will discuss going forward. But one thing to remember in this space, which the traditional markets are not familiar with, is crypto never sleeps. And the challenges of data aggregation, pricing, and risk, which again, we use the term OHLCV, which is open, high, close, low volume. These are the metrics that's used in basic calculation. And believe it or not, Derek, it's a huge challenge in crypto assets and the market that deal with asset classes, right? Unlike traditional markets, again, there's no open close that can define highs and lows. So we can look into Bollinger Bands and look into the averages and means and determine as to what are the outliers and remove the outliers and come to a decent number. So we need to rely upon moving averages, which has become a standardized vehicle to analyze these things. We look into temporal windows, which is time slots, and look at the averages of the time slots, and then further create another, above average, a mean of that particular element. So we've gone to new sort of models only because the velocity and veracity of data has led to purely analytical and compute challenges in data collection, data aggregation, modeling, and insights, which lets me and you make intelligent decisions. And I think that we live in this world, which means that we're interacting with other things like global macro events. And the overall global macro events do impact crypto, as we have seen in a previous discussion with stablecoin and or on-ramp, off-ramp. So we have to have a bridged perspective on combining macro, such as inflation, money supply, commodity, energy, as it relates to mining and liquidity, and overall adoption curves that drives this industry and understanding the patterns as they emerge. So you can see that suddenly now the task of the computational element of data has become exponentially high, that it is data always coming in. It's truly a global system. And in portfolio asset management, again, as we're researching the space and trying to understand and make sense of this, the approach we have taken is really 4 steps. I'd like to highlight that for audiences because I think this has resonated really well as I have spoken at conferences, at industry events, is understand the industry and classify the industry. And I think we'll spend some more time later on in terms of what was done back in the day in 90s, late 90s, the Global Industry Classification Standard, which was developed by Morgan Stanley or MSCI, and this GICS, which again is Global Industry Classification Standard, sort of provided you some elements of co-movement within sectors. So they created sectors in terms of transportation, media, entertainment, technology, electronics. They had all these different industries, and it helped them understand as to how this information impacts one industry and how it has ripple effect on the other industries. So we have done that. The first step is understanding and classifying industries. As you know, all token looks alike. There's a lot of memes around the tokens, and our approach is of layering helps in understanding what's a Web3 token, what's a layer 1 token, layer 2 token. So now, as you know, in the last research call that we had, Derek, we have about 17 different sectors that we have classified, and there's a miscellaneous sector because there are sectors evolving so fast it's hard to keep up, that we're revisiting this industry every 4 months in that space. So that's first step. That also gives you an understanding of your universe, right? Second thing is we define a criteria based on a thesis, and these criteria can be thought of as factors, meaning that nascent projects, while they may have massive potential, they also have a massive failure risk because they are new, they are nascent. The founders may not have the right idea, or they may not be a proven model. So we look into those. We look into the projects that actually have enough life in them, 4 years, they have certain market cap. So we take all those factors and codify them to say, if we have, and there are close to 15,800 plus tradable tokens, and it's impossible task to figure all of them out and make a blanket sort of investment. So we then, bring this down to a thesis to say, we're only going to invest in certain areas with this criterias. And then we shortlist that asset and tokens, which is a third step, and perform a fundamental and technical analysis. This is where things get interesting, because what is fundamental and what is technical in this case? And we look at moving averages, we look at transaction volumes, we ensure that there's no wash trading happening in these networks. So there are now, again, Messari provides more qualitative research. We look into, a bunch of, there's an EY project, there is a project that looks into coin metrics, for example, in looking into some of the technical analysis of how the what is the price movement in terms of volatility, trend, momentum. And those are all technical analysis, but fundamental analysis, we go back to the utility of the token and everything else. And that gives us a good idea in picking projects that have, that either is following our conviction, or we have the conviction to take the risk or the necessary risk, which has, higher, reward potential. And the last step, I think, is presenting this distilled list with conviction for investment consideration. Of course, there's a process to this whole thing. Otherwise, it's akin to the old adage, if you remember, Derek, monkey throwing a dart and a professional picking the stocks, and they weren't really much different in terms of their performance. And we do want to understand this industry in a much more, a defined manner. So there's a method to the madness and a balanced approach. And in my opinion, once you have this approach, then the question then becomes that, how do we collect the fundamental data? Because there is so much data out there. How do we do technical analysis? And I'll pause here. Love to get your thoughts before we explain as to what we have approached. And I think in one of the later sections, we should probably bring that and discuss that approach, because it's a little heavy and it deserves its own time, I think.
So there's two challenges with the data, and that is the amount of noise associated with data. So cleaning the data is a very important thing. And that's why I'm hoping in the next show that we've got coming on, we'll have our data scientist, Petros, join us and discuss that process. So it's not just getting the data, it's actually getting the data in a form that's relevant. And then, of course, you've got to be asking the right questions. And those questions can vary depending on the segment that they're in, whether they're in layer 1 or layer 2 or Web 3.0 or DeFi or metaverse, etc. That's part of this this qualitative view of the whole thing. So there seems to be a degree of both hard science and statistics and general knowledge of the space to be able to make this work. Would that be right?
No, absolutely. And I actually, even talking to Petros, who's incredibly brilliant, and he is, and just to give an example, Derek, that what took me a few months, I spent 4 months in doing all this work manually and looked into a few things. And, Petros was quickly able to create a model, ingest all this information, and spit things out within a matter of a week. So you can imagine the human effort taken to eyeball these things and create a methodology. But one thing did help is that our experience helped him quantify these criteria, or what we call as factors. So we will certainly invite, I think, Petros, our data scientist, to reflect on this approach, to make sense of this 15,000 plus different assets and distill them down into a handful based on our multi-factor models. And we should talk about those models and how we came up as an exemplar. And codification and employing machine learning, which is a field under artificial intelligence, I think can speed things up. And while we are not exactly going after quant trading type models for crypto, I think for including the VC and DeFi and some of the other fund structures, such analysis can only help in refining the thought process and enhance learning, which I think is more important than simply trading based on highs and lows and finding the patterns. Which could be helpful in short term. But if you're going after long-term investing, I think you should look into this from an industry perspective and having a deeper understanding of the space, I think. And that's why I think fundamental analysis, projects, the founders behind the project, these are all qualitative work that we need to do in looking at token economic systems of each project to see, is it truly a security? And if it's security, then should we choose that? Because that could present a regulatory risk to the investors on the long run. Only because, and so some of these things I think has to be a gut, which I think investment and some of these things are about gut feel, but the gut feel should be substantiated by some logic, some information that lets you make you better and informed decisions, which I think should be the right approach to investing, should be the right approach to taking risks, I think.
And that's why you have a thesis. If you've got a solid thesis in place that your fundamental guidelines that you're operating within, then you can build that, and your gut feeling then becomes actually within the parameters of that thesis and a lot more controlled. And another thing that's interesting is just the use of data science. I mean, in the Radiance Fund, we have a commitment to sectors and best of tokens in these sectors. But data science still plays a role in that. Obviously determining things like the wash through to see whether the trading results and momentum, et cetera, is correct. But the other thing is that even if there's a commitment into a particular token. If you see that the market's going to turn down, you may well just wait for that or put in some lower buy orders and reposition yourself in that same commitment. And data science is providing that. So we're not trading, so to speak, we're committed to certain areas. But the data sciences provides us information around sentiment and momentum, which can assist us in improving our positions each time. It's a huge amount of data. And as you say, it's 24/7. And it's a challenging area. So what does the average person do with this data, or not, for that matter?
No, I'll before I answer that, I'd like to second what you mentioned, right? That there's a discipline, and I think discipline plays a really, really important role. And you can see many of these funds who have run in the past in this existing sort of down market. You've seen some of the funds, and ARKK, for example, lost 60%, but the conviction is there. There's a belief system that leads to. And I think that while we come across, as we are analyzing this, many tokens that have a very short-term upside and a lot of potential, a lot of buzz, our discipline says that that's not part of that's not part of the model, because if that particular token has existed for just 3 months, then that has not met our maturity requirement, and so we will not expose ourselves or our investors to that base. So I think some of that discipline is really, really vital, which I second that. And to answer your question, what do people do with it? Well, there's an extraordinary amount of growth has created commensurate amount of complexity. So as you know, there are tokens coming in on an hourly basis, new tokens, new asset classes. There are NFTs. There are projects that are creating NFTs, and you have tokens popping up on a daily basis. There are at least 4 to 5 tokens that I hear about, and I simply can't keep up, even though I've been in this industry for a long time. So the question then becomes is, how do you understand the digital asset space? And so my advice to many of the newer guys that don't bother gambling away and saying, let me go buy this token or that token, to take time to understand the digital asset space. And efforts have been made. I mean, if you look at CoinDesk indices, they talked about, similar to what we discussed earlier, which is global industry classification standards. They have devised something called DAX, which is digital asset classification standard, which provides market with reliable structure and transparency to help classify and simplify industries inside the asset classes. Exactly what we did. And we did this even before DAX was there. We continue to refine it, which is a continual effort because of again, you have data tokens and you have Web 3.0 tokens. Web 3.0 have newer models for powering infrastructures. They have their own token, and you have data in AI, they have their own token. So it's impossible to leave the industry, the post-industrial world of automation, automotives and technology, and stick to those models, because this industry is moving rapidly. But classification helps us define the market is not new. We've done this for ages. So we understand that space. We understand the correlative elements. So I think that helps, starting with our first principles to know what we know and know what we don't know. We start with what we know and then build upon some of those elements. And I think that, research in general, and we of course have now 30, 40 years worth of data around this, that the GICS framework that explains the stock return, co-movement of the sectors, helping investors determine some of the important drivers for company valuations, mergers and acquisitions, identify relative value opportunities by comparing companies with the same sectors, which is again looking into saying, hey, are you in this tech sector, you're underperformer, you're overperformer because your cohorts are doing this and they're working for them and you're not. So it helps do a lot of things. And that's what we have done too in Web 3.0, is try to understand that why are similar projects not having the same valuation criteria at this early stages. And I think one factor that is that the fundamental analysis goes back to say maybe they have a bad token economic model, and that we learn from that token economic models and make the right decision. So developing a sector level macro insights to make decision of an asset allocation, to me, is the first step we can do. And it sounds very jargon laden, but it's simple term to say, how do you see the industry? How do you understand these different sectors? Mm-hmm. And how do you group them, if that makes sense, Derek?
And Nitin, of course, in the traditional industry that we've been certainly operating in, I have for a long time, you will wander into large stockbroking companies, and there'll be specialists in pharmaceutical, specialists in mining, specialists in gold mining. So within subsections of it, specialists in certain tech sections. As you know, there's specialists in just processes and things like that. So these guys have an immensely deep knowledge of the space within the guidelines they operate in. And they deploy large amounts of assets because the traditional industry has large amounts of assets by comparison to the 2 trillion that are deployed in this industry. But you see where I'm getting to. These sectors, these sector knowledge bases are going to grow in this industry too. You're going to see specialists that are going to be nothing but living and breathing the world of Web 3.0. Others that'll be dedicated to Polkadot's sovereign state environment that's operating and all that operates within it. These specialists will have real value because they'll have knowledge bases that the generalists won't have. And I see them becoming more and more important as we progress. In the meantime, of course, by us sectorizing this space, there's a word we just invented, sectorizing this space and analyzing each sector, it gives us confidence within the guidelines that we're operating in, that we're determining here's one that some people might not believe in the traditional world, the fundamentals of how this sector is working and how each one of those tokens are working. And that provides us with what Cathie Woods has got, which is conviction to each sector. Yeah. And it's extremely important for us. Meanwhile, of course, we have to know that we're doing this and having conviction with this section where macroeconomic conditions are impacting the space on and off as that occurs. And the way I always look at that is that, yes, the macroeconomic conditions, the tragedy that's happening in the Ukraine at the moment, the challenges that we saw not long ago with China removing the Bitcoin miners out of that, all of these had impacts on the space. Yeah. But the space continues to grow at an exponential rate. So I think we're going to see the space get hit by macroeconomic themes and then realize it's growing rapidly and move away from that. Our focus is always going to be on the performance of the space and continuing to build it, won't it, Nitin?
Yeah, no, absolutely. And, the entire conversation of mining, I think we can dedicate 5 more sessions to those because the more time and spending on it, both in terms of regulatory and the folks who are involved in mining. And if you look at their research report, they look into chip design, they look into water-cooled data centers, looking into energy equation in terms of how. So to me, it's a whole different science. And to me, regardless of the whole element of ESG around mining, the amount of innovation that's happening in that is generally good for every single industry because they're trying to optimize computing at a much lower cost points because of the energy cost. And I think in general, I think this is going to do good. So absolutely, I think a lot more to learn, a lot more to understand. And I think we all should, I'm definitely going to be at it, Derek, with you, and you're going to be with me in this journey for quite some time. And for our listeners, I would just say that stay hungry and stay open-minded and learn as much as you can, because that's the best way to get your arms around it. And still, we are still the industry, in my opinion, is still in its infancy, I think.
Yeah. Agreed, Nitin, beautifully said. Don't be overwhelmed. Sometimes people feel as though they're drinking from a fire hose. Maybe just take a cup at a time. But the fact of the matter is, as you do, you get closer to that moment when you go, aha, I get it. And that's terribly important. So for those listeners that are just learning about the space steadily, it's an extraordinarily exciting, invigorating, and refreshing environment to be in. And take it one step at a time. And hopefully we might be there for part of those steps along the way. So thanks, Nitin, again for a great session. We can go for another hour always. We can easily do this.
I think so, yeah.
But for now we'll finish, but with the intention that we'll get Petros in very soon so that we can start really talking about some of the data science that is behind the calculations and analysis that we're doing.
Yeah, it can get technical. We try to simplify it when we bring Petros on this conversation, because we did a lot of modeling. But I would suggest this, Derek, you should come down to Austin. We should have this podcast in person. I'll get some barbecue. I'll get some good microbreweries. And after the show, we should go and get some live music. And that would be the Austin way of doing things.
Fantastic. And maybe we can broadcast from the live music. I love it. I mean, it's a date.
Yeah, all right.
See you next week.
All right, Derek. See you next week. Bye.
We hope you enjoyed our weekly conversation. If you have any questions, comments, or suggested topics, please feel free to connect with either Nitin or myself on nitin@portal.am or Derek@portal.am. Feel free to subscribe and share with like-minded friends. Stay well, inquisitive, and engaged. See you next week. Bye for now.